Hey guys, welcome to my economic update for November 25th, 2018. This first article in front of you is about the price of Vancouver condos. So the article starts by telling us that active listings for downtown Vancouver condos in October were up 11% from the month before and up 93% from a year before when there were 433. The median prices for downtown Vancouver condos decreased 11% from September 2018. So just think about that for a second. That's from 2 months ago, September, until October, the following month, which was last month right now, an 11% decrease in the median price for downtown Vancouver condos in 1 month. So quite a significant change in market activity, at the very least. The article continues to say that there was a 21% median price decrease from the peak of the market in January 2018. So in less than a year, the median or average price of a Vancouver downtown condo has decreased 21% since January. And finally, the dollar per square foot also decreased 6% from September to October. Now, Steve Saretsky is a realtor in the Lower Mainland, and Steve also has his own YouTube channel that I've been watching recently, and I think it's quite good. He's a bit of a market bear, I suppose, as you might say I am as well, but he backs up his videos with really useful information, and points to interesting statistics, and I think he's got interesting citations. And so Steve Saretsky, I'd really recommend checking him out on YouTube if you haven't already, and subscribe to him. And his comment actually I sort of skipped past it. It's right above it here that the units, being units of Vancouver condos, are being sold at 5% off of the asking price. So just a point there to give you a sense of what the market has been like for these realtors is that rather than getting overbid on apartments, they are getting underbid and selling for under the asking price. And now to a different but related subject, which is interest rates. Interest rates have been going up for the last year or so and are expected to continue to rise in 2019. And of course, real estate property prices are a function of interest rates. So this is related to the price of real estate and the demand for real estate and other assets. I thought this article was interesting for a few reasons, so I kind of want to just read it out loud for you and then talk about some of the things that come out of this. Bank of Canada is studying whether it should make changes to the framework that has underpinned its policy decisions, such as interest rate movements for several decades. In a speech Tuesday, Senior Deputy Governor Carolyn Wilkins said the current inflation targeting approach has improved the economic and financial well-being of Canadians since it was established in 1991. But after a decade in the post-financial crisis environment, she said it has become clear that there are also downsides to the bank's mandate of helping inflation stay close to its target of 2%. So, guys, you should always be careful when the Bank of Canada steps out with a press release, because usually they're trying to flag their future intention, or they're trying to sort of test the market and test the public's response or the market's response to various ideas. So here they're talking about, right now they just use the interest rate target in Canada supposedly to guide the Bank of Canada policy. I suspect there's a lot of other reasons why they go in particular directions, but that's neither here nor there. Their stated or avowed reason is to track inflation to 2%. And here they're flagging for us and for the market that that is probably going to change. Even a well-functioning monetary policy framework deserves an open-minded discussion, particularly in the post-crisis world we live in. There are a couple of challenges facing our framework that mean it may not serve the economic and financial welfare of Canada in the future as well as it has in the past. One key issue, she noted, is that interest rates are no longer expected to rise as high as they had been before the crisis, which means there will be less room or conventional firepower for the bank to cut rates in an economic downturn. The bank can cut its trend-setting rate as a way to lower the costs of borrowing and stimulate economic activity. One thing she's flagging here is that interest rates are not expected to rise as high as they had been before the crisis. So what we're going to see pretty soon here is that our economy can't withstand higher interest rates. I think the central bank, the Bank of Canada in this case, must recognize this fact and is, I think, just flagging ahead for us that, by the way, interest rates are never going to get to 5% or 7% or 10% ever again if they have their way. So they're trying to flag that for the market and indicate that it's just not going to get to those heights. The other thing that this paragraph talks about is this conventional firepower. So this is this idea that really underpins the justification for all central banking and the fiat banking system in general, is that the central bank is able to lift economies out of an economic downturn by cutting rates and, for lack of a more delicate term, just creating money out of thin air. As this article says, lowering the cost of borrowing and stimulating economic activity. Of course, if you're suspicious of the fiat money system, you question the stimulative effect of such policies and observe rather that it tends to skew incentives and perhaps just create bubbles in certain economic classes where certain actors get the benefit of those cheaply lent monies first. But this article just is flagging that for us, that there might be a problem with the central bank's traditional, conventional arsenal of supposedly helping out our economy. So they're flagging that for us here as well. The bank, which has been on a rate hiking path thanks to the stronger economy, has said it expects its benchmark rate to eventually settle somewhere between 2.5 and 3.5%, about 2 percentage points lower than where it was in the early 2000s. Another concern about the current framework, Wilkins said, is that the lower rates may entice Canadians and investors to take on excessive risk. No kidding. Leaving the economy exposed to the ups and downs of financial cycles. Again, no kidding. Does that sound a little bit like, recent history? Long-running low-rate conditions have encouraged Canadian households to amass record levels of debt. All true and all really dangerous for the economy and for the financial well-being of all of us. She said the Bank of Canada is conducting research on alternative frameworks, including a higher target for inflation and a more flexible dual mandate that would extend the bank's focus to also incorporate labor and other economic indicators. Whenever the central bank is talking about alternative frameworks, again, we ought to be very concerned. They're going into their bag of witchcraft or their bag of tricks, and they're going to be coming out with some other ways to try to manipulate reality to accord with their intentions and their desires. So just expect more manipulation coming down the pipeline. Specifically, she mentions the dual mandate that would extend the bank's focus to also incorporate labor and other economic indicators. This sounds very similar to the way the Federal Reserve Bank works in the States, which has a quote-unquote dual mandate to target a specific inflation rate as well as low unemployment. So those are the ostensible dual mandates of the Federal Reserve, though again, I personally doubt that those are the metrics that actually drive their policies. The Bank of Canada's mandate is set by a contract with the Federal Finance Department, so that's a nice point to be aware of. And that renewal of that agreement is set for 2021, and that might be when the bank adopts some of these new things that it's flagging towards as probably dual mandate. The bank will also look at how it can strengthen the options at its disposal when it comes to quote-unquote unconventional monetary policy tools, she said. During a crisis, if necessary, the Bank of Canada can provide explicit guidance for the markets ahead of rate decisions, introduce negative interest rates, and launch programs such as quantitative easing. If we're talking about, well, if the central bank is talking about moving us towards a negative interest rate environment at the next economic crisis, there's just something topsy-turvy here, and I can't quite put my finger on the pathology of negative interest rates, but it's just completely contrary to any rationality or common sense. Who wouldn't want to borrow money if you got paid to borrow money? I mean, that is what they're talking about. They're going to pay people to borrow money. And now, truthfully, they've already been paying people to borrow money if you factor out real inflation rates. But they're just going to kind of go deeper into that. And I think that's just as sure a sign as any that this whole system is putridly pathological. So related to that, though in ways, again, I'm not sure I'm quite qualified or knowledgeable enough yet to articulate fully, and maybe I file this under one of my videos of things I don't understand, but this is an article that I think starts pointing to the way that negative interest rates can make sense in certain circumstances. There's never been a more profitable time for U.S. investors to ditch treasuries and to go abroad. By now, everyone knows treasuries have been a lousy bet. But because of a quirk in the way currency markets work, there's even less reason for investors to park their money in U.S. government bonds. Those with dollars to spare can lock in historically high returns in Europe and Japan, even though yields in the two markets are among the lowest in the developed world. In fact, dollar investors are getting paid more than ever to enter a trade that takes the currency risk out of their euro-based returns. As a result, they can earn what amounts to 3.8% a year from ultra-low yielding 10-year German bonds, more than half a percentage point above treasuries. Aside from Italy, hedged U.S. investors would have done better putting their money into the bonds of any developed nation this year rather than treasuries. The reason is simple. The trade cuts both ways. While U.S. investors have few incentives to stay at home, the sky-high cost for foreigners to hedge the dollar means they have little cause to buy treasuries. In some cases, their effective yields can fall below zero. Any let-up in demand could drive up U.S. borrowing costs at a time when the government can ill afford to lose investors as it raises ever more debt to meet its widening budget deficits. Of course, bond investors can always opt not to hedge, though making a bet on the direction of currencies entails an added risk. And prior to the latest sell-off in treasuries that pushed 10-year yields to the highest level since 2011, data compiled by Bloomberg showed that the major foreign holders actually upped their stakes by $35.4 billion in August, although their share of the market still fell to the lowest in 15 years. To make matters worse, the situation could persist for years to come. Shorter-term interest rates, which determine relative hedging costs in the currency forwards market, are far higher in the U.S. than in the Euro region, and likely to stay that way until the European Central Bank catches up to the Federal Reserve. The Fed has raised rates 8 times since 2015, and some forecasters expect 3 more by the summer of 2019, when the ECB has indicated it will finally start lifting its policy rate from 0. So I can speak to this again just a little bit. I mean, broadly speaking, I do understand hedging to be a process where you buy different, when you make an investment in a particular asset, let's say treasuries in this case, you of course have to buy that asset in in the currency of the local market. In this case, that's US dollars. So what hedging refers to is buying complementary assets or let's say insurance products that move inversely to the value of the currency in which you purchased the asset, right? So the idea being is if you suffer a US dollar loss after you've bought treasuries, your other assets that you purchased or the other insurance that you purchased, they're going to rise proportionate to the amount that your treasury values are going down, or the dollar loss that you suffer with the treasury. So that's the purpose. That's what hedging is. And I can speak to it to that point, but not on a deeper level of why U.S. hedging is costing more than European hedging, and specifically, mechanistically, why that results in these significant differences in profit and return on these yields. So I'm just putting a pin in that particular point. Hedging profits. That means trading desks need to pay up to get investors to swap their dollars, which earn more interest or carry in trader speak than euros. The trade works like this. A dollar-based investor buys euros, which currently sell for $1.1574, to invest in euro debt. To hedge against currency swings, she simultaneously enters into a forward contract to sell back the euros in 3 months at a fixed price, currently 1.1668. That transaction normally incurs a marginal cost, but now it produces a return of 0.81%, or nearly 3.3% annually, the most since the euro's inception in 1999. A similar pattern holds true for cross-currency basis swaps, a hedging strategy used predominantly by multinationals and central banks. That's all I'm going to read from this article, and just to highlight this hedging effect, and or more generally, or simply to say that there are reasons why a very low interest rate could be still attractive, and I suppose perhaps even theoretically even a negative interest rate could somehow still turn out positive for an investor when considering the hedging costs. I saw this article on CNBC, and I thought I would just flag this for you, that there is some changing sentiment as to the number of rate hikes that market participants are expecting. Of course, this is just expectations. It's not a crystal ball. It doesn't mean that the Fed is less likely to raise rates more often than they were already. It's just expectations, and of course, expectations in the market are important. So I just wanted to sort of flag that real quick and read through this article quickly for you. In the past several days, and this is from November 19th, the markets have become convinced Fed officials are intentionally signaling that they could pause from raising interest rates next year. The recent speeches from several officials have been interpreted as being more dovish, even if the officials haven't strayed much from their core message, that the Fed is on a gradual rate hiking path, that the U.S. economy is in good shape, inflation is steady, and the Fed remains dependent on economic data. But the market also is interpreting a new tone in the words of these Fed officials, who seem to be more seriously looking beyond the strong U.S. economy to an environment where stock prices have been falling and credit spreads are widening. Powell noted on Wednesday that there's been a gradual chipping away at global growth, and that what happens internationally matters. And the same point was made on the previous Friday by Fed Vice Chair Richard Clarida, who told CNBC that the global economy deserves attention and it looks like it's slowing. There's a bit of a walk back in progress, according to the chief economist at Strategist Research, and he's sure that the Fed is looking at financial conditions. The market's interpretation of the recent comments is in sharp contrast to the response to Powell's October 3rd comment that the Fed is still a long way from neutral. That comment was interpreted to mean the Fed was confidently moving forward with the rate hikes it has already forecast for 2019 and possibly adding more. Now, the markets still expect the Fed to go through with a rate hike at its December meeting, but the 3 more hikes anticipated for next year are in doubt. There's a funny section down here about the Fed in a dark room. I think Powell said something about said some comment that the Fed or the market is in a dark room, so they'd be moving carefully. I find this discussion at this point is sort of humorous because these people are trying to interpret what Powell meant by being in a dark room. And and here this person's certain that if you're in a dark room, especially without your shoes on, you want to go slow so you don't stub your toe. So I think what that means is that they're going to be more data dependent. Like, this is just, I realize I'm doing this right now, but here we are, these market analysts, myself, and many other people who are interested in the market and trying to understand where it's going to go, are poring over these comments, these minutia of Mr. Powell and other Federal Reserve officials and other central bank officials, which is understand. I understand why we're doing it, why I'm doing it, why this article is doing it, is because we understand and they understand, perhaps without coming out and saying it, is that the Federal Reserve and the central banks around the world really are set the direction of the market, that really are in today's economy, in today's pathological broken economy. Fundamentals are the waves, interest rates are the tide. So we've got to pore over the comments of these central bank officials to try to glean their intentions, because effectively, as I said, it's not about fundamentals. It is about gleaning the mind of Powell and other officials who are going to exert this godlike power that we've granted them to manipulate the market in the direction that they think is correct, or it's according to their desire. So I just find this funny. Fed in a dark room. Yeah, I mean, it's more like fed in a psychic reading. Finally, I want to end on a optimistic note. Optimistic or not so optimistic. I saw this headline and opened up this article, and I thought it was quite a hilarious article in a sense. I haven't commented much about Turkey or emerging markets have been really suffering this year. Their equity markets are down significantly. There's a number of nations that are suffering extreme inflation, and Turkey has been one of the worst. I believe, to my recollection, their last recorded inflation number was something like 25%. And I think that was from October, if I recall correctly. So that gives you just a sense of how quickly their currency has been declining in value. This is all tied into the Federal Reserve's actions and the declining liquidity, which, as I said, it's the tide that lowers all boats in this case. So I really think all of these nations and all of these currencies are going to have troubles ahead. Well, they're going to continue to have troubles ahead, where they haven't had troubles yet. They're going to have troubles ahead. Turkey's been suffering because a lot of their businesses have and government have borrowed a ton of money in U.S. dollars, and as the U.S. dollar has gone up in value because it's the number of U.S. dollars is decreasing, so as the value of the U.S. dollar has been going up, there's been some question about whether Turkey and the companies in Turkey and around the world are going to be able to afford to pay back these U.S. dollar debts when the value of their own currency has been going down. So Turkey's been one of the worst ones, not the absolute worst, but people have been very concerned about Turkey. So I thought I'd open up this article about how optimistic Erdogan, who is the, I'm going to say president, yes, President Tayyip Erdogan, is optimistic on economy as interest rates fall. This is a very short article. You can see it all in front of you here. Turkey's interest rates are falling and the lira is firming, giving concrete reason to be optimistic about the economy, President Tayyip Erdogan said on Wednesday. This is from November 21st. Second sentence. Erdogan added that shops that keep food items like onions and potatoes in stock, causing prices to increase, will be raided if complaints are received about them. So, not exactly my kind of confidence, that's not the actions of a very confident man. Like, oh, yes, everything is fantastic. The market, the economy is just, it's ticking along. And if you keep any onions and potatoes in stock, we're going to raid you. Of course, that is not a optimistic economy. An economy near panic, right? That is an economy that sounds more like it's about to collapse. If storing onions and potatoes is a threat, such a threat, a perceived threat to the economy, that they need to bring the military in, or the police, whoever's going to do these raids, obviously something is fundamentally very broken there. So I would not be as optimistic as Mr. Erdogan claims that he is. That's all for today. I will try to get something together in the next week or 10 days once again. Thanks so much for listening. You have a great day now.